Chapter 13. Introduction to Mortgage Finance. In mortgage financing, a constant payment mortgage is one where each payment is identical to the preceding one. All other things being equal, the type of loan with the most risk to the lender is an interest-accruing loan. Which of the following elements are not considered in determining appropriate rates of interest on mortgage loans? The amount of property insurance. Which of the following was created by Canada Mortgage and Housing Corporation, CMHC? Canada Housing Trust Bonds. Which of the following is not a reason why an investor would use borrowed funds instead of an all-cash offer for a real estate investment? To invest the borrowed funds at a lower rate of interest than the borrowing rate. Which one of the following is not a primary motivation for investment in real estate? A need for short-term funds to finance the acquisition of chattels. Which one of the following is the best reason for an investor to choose to use debt financing rather than all cash in order to purchase an income-producing property? The investor can obtain the debt financing at a lower interest rate than the expected yield on the project. The secondary mortgage market is the market in which existing mortgages are bought and sold as financial investments. Which of the following statements regarding mortgage default insurance is false? The insurance company guarantees borrowers will be able to continue to make their mortgage payments without interruption. Which of the following is not a private lender? Credit unions. Which of the following is not characteristic of a mortgage as an investment? Mortgages require a low degree of administrative work. In which one of the following mortgage repayment schemes do the monthly mortgage payments increase on a regular basis? Graduated payment mortgage. All other things being equal, shortening the contractual term on a constant level payment mortgage always has the effect of increasing the size of the outstanding balance payment due at the end of the term. Which financial institution is currently the largest single source of institutional mortgage funds in Canada? Chartered banks. A borrower would prefer a straight-line principal reduction plan to a constant payment plan if the borrower foresees their income decreasing. Which of the following is not a characteristic of a mortgage as an investment? Has short repayment terms and amortization periods. By extending the amortization period of a loan, the repayment of principal is spread over a greater number of payments, making each payment smaller. An interest-only loan has an original loan amount of $15,000, carries an interest rate of 6.5% per annum, compounded semi-annually, and has monthly payments of $80.17. When will this loan be completely repaid? Impossible to determine from the information provided. Which one of the following is not a reason why an investor would use borrowed funds instead of an all-cash offer for a real estate investment? To get a regular and predictable return on capital. Mortgage interest rates are sometimes described as being sticky, that is, changes in mortgage rates tend to lag behind changes in bond yields. One reason for this stickiness is the weak secondary mortgage market. On a straight-line principal reduction loan, the monthly payment declines over time. A $46,000 second mortgage with interest at the rate of 15% per annum, compounded monthly calls for monthly payments of $643.81 over a 15-year amortization period and a 3-year term. The loan is based on a partially amortized repayment scheme. Which of the following is characteristic of a mortgage as an investment? Requires a high degree of administrative work. The risk involved in being a mortgagee, a lender of funds secured by a mortgage, is increased due to the greater degree of management time involved. With which one of the following loans is the lender's initial capital and periodic income at the greatest risk? Interest-accruing loans. Two mortgages requiring constant blended payments are identical in all respects except that one has a 5-year term and the other has a 2-year term. The monthly payments on the 5-year term mortgage would be the same as those required on the 2-year term mortgage. Between 1900 to 1920, interest-only loans were the primary form of repayment for residential mortgage financing, whereas after the Depression, long-term, fully amortized mortgages were the primary form of repayment for residential mortgage financing. Constant payment repayment schemes developed in response to principal risk. Which of the following is the main reason that interest-accruing loans are normally written for short terms? The lender's return and original investment are at risk for the entire term of an interest-accruing loan. From the point of view of the lender, the interest charged on a mortgage does not represent the cost of financing the lender's debt.